Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Demetri, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This show is all our shows is concerning Market Chameleon tools and products. With that, good morning and welcome back, Dee. I know we were off for a couple of days with technical issues, but we're back here and
Yep.
ready to go.
Good morning, everyone. I'm going to share my screen here, and as as I'm doing that, I want to remind our viewers we have a webinar coming up tomorrow with Interactive Brokers. It's going to be at, I think, is that 2 p.m. Eastern, Will?
2 p.m. tomorrow, we have a webinar with IBKR, and I think the topic is
We're going to cover
single leg options trade.
single leg options trades. Yes. So we're going to look at different analytics and different perspectives to analyze single leg trades. And that will be tomorrow, 2 p.m. Eastern. You have to register with Interactive Brokers. To view that video, they're hosting it. So it's not going to be on YouTube like we do our daily routines.
Yeah, and just an FYI, I don't know if I've mentioned it to you, but Jay Soloff is doing a webinar today, also on our YouTube channel at 2 p.m. So
Oh,
I'll be
okay.
hosting that with Jay, and I'll put a link to that in the chat as well.
Okay. Yep. So those two links are going to be out there on that live chat if you guys want to join us. So we will cover today our long call option screener, and this is a continuation from the previous show that we did last week. If you are looking for this particular page, it's up here under screeners from the main menu. If you move towards the right side, you see single leg option strategies, and it will be long calls. You click on that and you will land on this page. And last week we talked about some of the different data elements that are in this table from left to right. And we covered, I think that we covered the summary page. Then we stopped there and said we'll continue on some of the other analytics that we have on other tabs. And we'll use the filters above to narrow down the potential candidates. And in this situation, keep in mind, we are looking for screening call options from the perspective of the long side. If you're looking to purchase options, which have obviously a different risk profile than if you're selling options. And really quickly, I'm just going to cover from left to right here. You see the stock symbol with stock price, price change, market cap. Over here, I'm going to skip this middle section here just to show you that the call that you're analyzing will be in this section. So you see expiration December 20th, strike 247.5, and this is the delta of the option. Then over here in the middle section, we have some analytics. We are analyzing this option from the market price, which is the ask price. So when you're looking at a call option, we're looking at a market, you have a bid, you have an offer, the option's worth anywhere in between. You could obviously try to negotiate a better price, but since the ask price displayed is a firm price that you can buy that option at, that's the price we're analyzing. And then we run some statistics here based on our theoretical value, theoretical edge, historical win rate, and probability of touch. We discussed all that last week in our previous video. So one other thing here, when we're looking at this option screener, we do have a default here to pick an expiration. Since options have different expirations, you could analyze expirations that are shorter term, a specific expiration, looking for longer term And you could choose it from over here in this drop-down menu. By default, when you come to it, it just looks at the next monthly expiration, and you could change that from this filter over here. So in this webinar, we'll discuss looking at an option from a historical statistical advantage. And when we look at all these different options here, these are all sorted by the stock's market cap. So you see a lot of Apple options here. If you click on any of these columns, it'll resort it, lows to highs, highs to lows. And when we look at these different options, we have these prices, and we don't know what the outcome is. Obviously, the outcome of the option, what it will be worth, depends on what the stock will do and what the implied volatility will do. However, we don't know what's going to happen going forward, but we could try to analyze the price of this option relative to its historical benchmarks. Well, is it the way it's priced? Is it priced on the high end? Is it priced on the low end? Statistically, given this price, what are the historical odds that it will be worth more or less, the same? We could start analyzing it from that perspective, because we could then apply the data that we have available. So let's look at it from two different perspectives today. And there are many different ways we could analyze an option. Run different models, different data sets. So we're going to start out with two base models to analyze it from. And one way is to look at how the stock performed. Well, how does the stock usually move around, right? And if we look at that, then we could say, well, based on how it moves around, going up, going down, by what percentage, what do we think that this option may be worth on average over a long period of time? Because if the stock doesn't move at all, let's say just sits still at one price forever, well, then all these options will be worth zero because the stock won't move. And then why would you pay for an option to buy, the stock at a higher price if you don't think it'll move to that higher price? So we have these two tabs here. One is looking at the historical returns of the stock. So this is the historical distribution. Okay. And it's calculating, all these analytics. So we have it here as reference when we're trying to run our analytics. Because if you're looking at each individual option, right, each individual option in here, it has an expiration. So there's a certain amount of days that this stock can trade before this option expires. It also has a strike, so the stock has to move to a certain point for this option to at least break even or to be profitable at expiration. So if you're buying a strike that's out of the money, well, the stock has to move towards that, above that strike, and it also has to cover the cost of whatever premium you're paying to cover, what you paid for it and to become profitable, right? So what we want to try to evaluate is like, well, what are the probabilities, chances of that happening, given provided its historical return distribution, how it moved historically. So over here, let's go to our historical distribution tab. And when we look at Apple, right, we're looking at, here's the stock price, $242.73. The strike price is 247.50, so Apple has to, at expiration, be above 247.50 for this option to be in the money, right? It has to move higher. And it also has to go above the 247.50 by $1.28, right, to cover the cost of that option. So let's go back over here, historical distribution, and let's look at Apple's historical moves, right? And here we see that given this expiration, December 20th, we got 10 days holding period, 10 days of trading days. Historically, let's look at that scenario. How does Apple usually move in a 10-day rate, in a 10-day period, right? So we got two reference prices, a start, and then 10 days later, how far away does Apple move from that reference price? So sometimes it can be a change, sometimes higher, sometimes lower. Let's look at that. Let's look at those scenarios. And in addition, we want to try to take out some periods with known factors that can move Apple stock differently, that we won't experience in the next 10 days, such as earnings, right? So if Apple's not expecting earnings in the next 10 days, and historically we have observations where there are earnings periods, and that could create more volatility. They'll move at a higher volatility because of those events. Well, let's remove that from our analysis. We want to remove those because we want to try to analyze data that looks similar to what we're expecting the next 10 trading days. So given that, we're going to look at those data points historically, and here we have 42 observations. Okay, so 42 historical observations of returns for 10-day period. And we could control the number of years from up here. If we go to historical distributions, you see number of years in our data. You have 2, 4, 6. So let's keep it at 4. If you want to go more, if you want more options, then you have to go to the options chain and set that. But for starting points in the screener, we give you 3 different potential data sets to analyze. Okay. So what this is saying is that in the last 4 years, we had 42 observations. And what did the stock do? Right. The next question is, well, what did the stock do during these 42 observations? So here it says 64% of the observations, the stock went up. Okay. So wherever it started from, 10 days later, the stock was higher. 35.7%, the stock was lower. Okay. Well, on average, what was the returns? And then we know the frequency of up moves, the frequency of down moves. However, keep in mind that stock prices, stock returns vary, right? That the up moves could be 1%, the down moves could be 10%, some up moves could be 12, some 20. So they're going to vary. They're not always exactly the same. It's not like when it moves up, it's up 1%. When it moves down, it's down 1%. It doesn't work that way. The returns could be all over the place. So what if we took all the returns and took the average, right? Because even with, and it's very possible, you could have 35% of the time the stock was lower, 65% it was higher, but on average, the returns could be negative. because the down moves were much greater in magnitude than the up moves, or vice versa. So let's look at the average of all the moves to see if it was positive or negative. Okay, so this is looking at that. The average of all the moves for Apple in this data set was 0.8, positive 0.8%. So that shows us that, so there wasn't a downward skew there, pulling it down. So on average, the moves were positive 0.8%, and the frequency of up moves exceeded the frequency of down moves. So that's this part. Well, we could also analyze it from another perspective. And let's say, even though it is, up 0.8%, there could still be a skew there with one big outlier, let's say, on a positive note. Like out of those 42 observations, what if there was one observation the stock was up, 100%, which was way out there, and we're not expecting something like that again, and we might want to take it out of our observations. Maybe they created like once in a lifetime new product that they announced, and it's so rare we want to take that out of our observations. So another way to look at our data set is, let's split all our 42 observations, run it from, let's say we sort it from highs to lows, right? We're looking at the data and we're like, okay, we want to sort it and look at our data from lows to highs, let's say highs to lows returns. And then let's look in the middle and split it up. Half highs, half lows. And what is the percent return in the middle, the median return? Because this will give us an indication also if there's some kind of a skew to the average. So this is the median move right here, 1.3%, meaning half the observations were above 1.3, a positive 1.3, half below. So this indeed shows us that in a 10-day hold period, historically, stock tended to move higher, right? Its tendency is to move higher. And we could see here, if we just look at the average and the median, about 1%. So there's a let's call it a historical positive drift, right? In favor of Apple. If we're looking at options and statistically, we're just using those historical data points. Over a 10-day hold period, this data shows us that there is a positive drift of about 1%, let's say, on average. Doesn't mean it's going to happen every time, obviously, but that's what history shows us. So then let's say we wanted to analyze this a little bit further. And we see that yes, that's the average. We have an average benchmark about 1%. But what if we wanted to do the followings? And let's say we're trying to look at our potential risk and reward. And we wanted to say, if it is positive, right? Let's say it is positive, and if the next 10 days is positive, and we're correct, that means that we wanted to look at, on average, what are the positive moves, taking away the negative moves, historical negative moves. So let's just say we wanted to just look at the positive moves to see how much can it potentially move. Obviously, if it moves up, it's not down. So when we do see a positive move, on average, how much does it move up? And if it does move lower, on average, how much does it move lower? Like how much, if I'm trying to strategize, or, I could do a call spread, or could do, sell something against it. So on average, how much does it move down? Well, this is the analytic over here. So on average, historically, out of these 42 observations, right? We have 42 observations. We know that in those observations, 64.3 of them were higher. So if we took those 64.3 observations and said, okay, what is the average move? Some could have been slightly above zero. Some could have been, 10%. So what do those look like? So on average, those are up 3.8%. Keep in mind, this removes all the historical negative moves. And what if we wanted to look at our potential downside, right? And we took these 35% and said, okay, what do these look like to the downside? So we removed just the negative moves from these observations, took the average, that's negative 4.5%. And this shows us that, the down moves, when the stock was down, on average, that magnitude, exceeded the up moves. The reason we have a positive, though, is because the up moves were more frequent. Okay, but it's something to consider, especially if you're strategizing and you want to, and you're looking at this, you want to see how that stock behaved, right? To the upside, to the downside, on average, frequency. So now we have these statistics in front of us, and we could filter by those statistics. We could come over here and we could look at, we already have set number of years, but if we wanted to see stocks with positive returns above 70%, right? So we could look at that. And now we have here positive moves above 70%. So here are the stocks here. If we wanted to look for stocks with a certain average return, let's say above 3% on average, click here, and now we have that. And then we could look at the calls, for those. But let's stick here to this. Same thing with the median return. We could just keep filtering them down. Maybe median return about 4%. So now we have 17 observations. And keep in mind, this is only looking at December options. But let's clear that out. I'm gonna hit clear here. And we're back to all our observations, which are 10,000 different call options that we're analyzing in the December 20th expiration. So that's looking at a 10-day hold. But the next question may be, maybe we're in December right now, and we have holidays coming up. We have, end of year coming up. We maybe, earnings are already, a lot of them were announced. Maybe the stock behaves differently in this calendar period than, because we're looking at 10-day hold periods, but that will include, every 10-day hold period that didn't have earnings here in this situation. But that would include, movements in January, and February, or March, April. So what if we wanted to, in addition, see how this stock behaved during this calendar period? Maybe it looks different. So that's this one, historical seasonality. See this tab? We click on that. And here, if we go here, this is the analysis. Now we're analyzing from December 6th to December 20th. So as you see, December 20th expiration. This looks at end of day December. Keep in mind, we're not open yet. So this is looking at end of day data from previous day on Friday. So it's analyzing the periods December 6th to December 20th, right? As of Friday's close. And it's saying, okay, just show me how the stock performed during that calendar period. Well, that only happens once a year, right? So it's going back now 12 years. This is going back 12 years just to get some data. And how did the stock perform during that calendar period? And you could see here, just for that same option, the observations have changed. Now you're looking at a 50-50. Half the time it was higher, half the time it was lower. And on average, the move was down 1.5%. And the median move was down. So the two data sets now that we're analyzing kind of have these different conflicting viewpoints that on average on an average 10-day hold period, Apple tended to move higher. However, if we looked at a data set that just looked at a specific 10-day hold period in a calendar calendar period, those observations look different. Those look weaker, suggesting that there's a disparity difference in those two data sets. That end of year, or let's say in December, in that 10-day hold period, the stock didn't perform historically as well. And you could see here that on average, the average up move was still 3.4%, which is similar, right, to the 3.8%. But if I go back to seasonality, you could see the down moves were greater, on average 6.3%. And the down moves were more frequent in our analysis. So then something now to keep in mind, that these two analytics, show a little bit of a different story. So we're right up, Will, at the 9:30, so I'm going to stop right there.
Well, that was an excellent job, Dee. As always, we apologize for missing the end of the week due to tech issues, but it was good to have everyone back on today. Great job bringing this webinar, Dee. We'll continue the webinars through the week, and we do have a special guest today that I'll be interviewing. Jay Soloff's coming on at 2. I have the link to register. That's just on our channel, so everyone will get notification and an email at probably around 1:45. And tomorrow we have the monthly IBKR webinar with Demetri. What's the topic again, Dee?
We're going to look at analytics on the single leg trades. Calls and puts.
So single leg options trades will be discussed at 2 p.m. tomorrow on the IBKR webinar. You have to register on their site. That link is also in today's chat. So hopefully we'll see everyone at all the events. And if not, you can catch them after hours. All ours are stored on our YouTube channel. Make sure you register for the YouTube channel. And IBKRs sit in a library. We have over 35 webinars with IBKR. So great job with those, Dee.